Hello, 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 people. How are you guys? And I'm glad to see everybody. Melinda, Jean has always a camera on, right? This is what I love about Jean, right? And Melinda has like some enforcement there behind her, right? Who's that little boy or girl, right? With Mario, Mira, Vlad is here. Oh my God, like it's getting full, guys. It's getting full. And I can tell you today. Today is the day. I'm waiting for this for a long time. You see that I'm not alone here today. I have like, yeah, almost like it feels like he's my friend, right? He's a fellow investor. He is super open-minded. He is probably the most uncommon CPA I know. He's a real estate investor. Um, he's with us today, Larry Pendleton. And Larry, I don't want to just like put that together. Tell us a little bit upfront who you are, what you do, and I know that you prepared a bunch to bring to the audience how they can optimize and do their taxes. What's important, what's not important. He will share all the secrets today, and he's a licensed CPA, so he's the authority in doing that. So, Larry, kick it off. Tell us a little bit about yourself, man.
I appreciate Robin. Good evening, everybody. Larry Pendleton, the investor CPA, based out of Norfolk, Virginia, Hampton Roads. If y'all familiar with Southeast Virginia, been doing tax advisory, tax prep for over 2 decades now. If you can't tell by the grays in my beard. Been investing in real estate for over a decade, roughly around a decade now. Uh, Traditional routes, flips, short-term, long-term, mid-term rentals, syndications, buying land, new construction, done just about everything except for wholesaling and being a real estate agent. I kind of know what my limits are, so I've been able to kind of take the boring tax side of the world and combine it with the sexy investor side and merge it together to help people understand of one first and foremost not about the saving on taxes. First and foremost, like is it a good investment, and then does that investment turn into a good tax saving vehicle for you? So grateful to be up here, and I do have some slides. I'm going to request to.
Before we start that. What I really admire about you is you're so like you're involved in like literally everything, right? So you do like traditional investing, but I also know that you are really huge on the affordable housing side. You want to talk a little bit about that, the projects you're doing, especially on that end. Bring us a little bit in that stuff. And I know that you're looking for land there too, right? So maybe here's an opportunity to work together with the group, right?
Yeah, I've been blessed to be on the planning commission for my city for the past 2 years. So we, we hear it all across the board. It's not just our city. I'm pretty sure everyone up here, their city is going through the same thing about affordable housing, without just it being Section 8 or LIHTC apartment buildings. So we're taking a different approach of how to really get more affordable home ownership. And well, of course, we're starting local, but we're looking to expand it. So we've been able to talk to city officials, kind of get their feedback on like, hey, if we have the land at this amount and we can build these houses at X amount of dollars, um, we can fit this into a model where your teachers, your police officers, your firefighters will be able to afford a market price home, and get a loan that will still only be about between 25-30% of their monthly take-in. Because as you all probably know that this the with the interest the way it is, prices, the wages for the workforce, the people that actually run the cities are it's not feasible at this point. So that's what we're looking to do is acquire land, build a affordable home ownership, and put people in a solid position to build wealth for themselves by starting off by owning a home.
I love that. And that's really inspiring for me because you really take action, right? This is what I admire about you. So, man, kick us off. I thought, no, you brought some slides and hey, give us your juice. And I'm pretty excited. I put a notepad here on my site and let's rock and roll, guy, man.
Yeah, let me see if She just sent a message to Baruska to
Mariska?
allow me to share. I know there's been some issues before.
Oh, really? Otherwise, Mariska, maybe you could give like, oh no, there it
Well,
works. I can see your screen. It's going on. Okay.
awesome. Great, great. So, um, yeah, because of Robin, what you do, I figured that the kind of the base of the group is around land investors, but it could apply to um, multiple sectors in real estate itself. But like I said, I just want to make sure I hit the focus of your particular group, and uh, I have a few slides. I am happy not to go through each one, so if y'all have questions, please reach out. Here's a little bit more about me. That picture in the middle. Hey, I'm a model as well, so if y'all need someone to model some clothes or whatever, I'm your guy. But but like I said, just kind of this is more of a collage about everything I do. Family, wife and kids, two big head boys drive me up a wall as well. My business partner Terry on, who's kind of been with me from the very beginning. Just different deals that we've done locally and in multiple states as well. Like I said, syndications, new home constructions, so forth and so forth. But I say all that because truly my mission is to help people achieve financial freedom by building passive income and saving on taxes. I call myself the investor CPA because if it's not a good investment, the taxes don't really matter. So we want to make sure that we're working with our clients on finding the right investments for what they're wanting to do and how they want to build their financial freedom, and then make sure we align it with the right strategy. How we do that is like we kind of, you all probably see this, those that read Robert Kiyosaki, Rich Dad Poor Dad, from a cash flow perspective, but there is a tax perspective as well when it comes to this cash flow quadrant as well. On the left side, there is where most of the taxes are being paid by employees and self-employed individuals, small business owners, I should say. And as we go through the slides, it will make more sense of why self-employed individuals, especially if you're just a small time flipper, real estate agent, stuff like that, you'll see why your taxes are highest amongst everyone. But we try to get our clients to that right side, more so the investors of how do we get your taxes, especially your effective tax rate in that 0 to 10% range, and not overpay Uncle Sam what was not needed at this point now, especially nowadays. Um, so I do have a few slides. Give me about 30 minutes to kind of go through, but please don't hesitate to interrupt. We'll talk about dealer versus investor status when it comes to being a land investor, being a real estate investor as a whole in general. We'll talk about entity structures, like how, even though this is not a legal talk, but we'll cover how the proper entity structure could help you save on taxes as well. And we'll talk about real estate professional status also, and how to apply, how to um, you can be eligible to apply for that, as well as like when does it make sense, or how does it impact you from there. Quick disclaimer, this webinar is for educational purposes only. This should not be taken as legal or tax advice. If you do have questions about your particular situation, there's a QR code above me. Please don't hesitate to schedule a time to meet to talk about your particular situation, but this is more so for informational purposes, and not so much directed to your situation. So talk to your advisors, talk to your attorneys, talk to your tax expert to make sure that whatever I'm saying does apply to you at that point. Are we ready to rock and roll? Got through all that stuff there. Nice. I'd like to do my presentations a bit differently, where I have an avatar of a client, and his name is Jerome, and he's just basic a hodgepodge of all the questions that my clients typically are asking me. So I want to I like to address people's questions before they come to me, especially in presentations like this. So we'll go through. one of our advisory sessions with Jerome all together. Kind of a bit background. He's been flipping properties in general since 2016. Was making pretty good income, net 92 a year, but his tax bill was averaging $31,000 a year, primarily because he was just working with a tax preparer, never really working with a tax advisor. So he wanted to invest into that so that we can start to kind of help him get that tax bill lower. So that's kind of a common mistake that I see a lot of people that they assume that their tax preparer is helping them save on taxes. Some people are just good at data entry. There's nothing wrong with that. There's a time and place for it. But if you really want to get a handle on your tax bill, you have to invest in yourself and get a tax advisor in place to help you with that. So many in the in especially in the land flipping business, I know a lot of you all do a lot of seller financing with your deals. And what tends to happen is that like, hey, I thought I can defer these gains over a certain period of time, but I'm not but you're not seeing a difference between if you sell the property outright versus you selling it through a seller financing to try to help defer the payments. The reason for that is because you're in the situation that you're either a dealer or quote unquote investor when it comes to the IRS, and it is classified differently of how you're taxed, and we'll go into bit details here. Um, so an investor, whether it's a piece of land or a house, like, okay, are you holding it for appreciation? Are you holding it long term? So at least a year. So, okay, if the property is held for at least a year, you're basically your initial intent wasn't to sell it, but actually to hold it, and you're not doing a whole bunch of these transactions a year. There's not really a guide from the IRS. It's just more so infrequent or occasional sales. So I typically say less than 5 years, and you're not marketing. Okay, well, you're not considered an investor at that point. Now, the benefit of that is that you have the 0, 15, 20% capital gains tax rates, depending upon where your total income is. Your income is not subject to self-employment taxes. So as employees, and most of us probably have been or still are, that's the 15.3%, or that your employer pays half and you pay half. As a self-employed individual, you pay the whole 15.3% by yourself. But when you're an investor, you're not. So you get that benefit. You also get the benefit of doing 1031 exchanges, where you're just selling one investment and you can roll the gain to the next investment. And you can also take advantage of the installment sale. Like, that's the piece there. People are like, I want to defer these gains and just collect payments and not be taxed on the full thing. You qualify as to be able to do that deferral method as being an investor. As a dealer, however, when you're just holding property short term, like inventory, you're selling more than five of these a year, and you're actively marketing that you're a land or property buyer and seller, you're taxed differently. So you see the tax rates go up significantly depending upon which tax bracket that you fall into. You are subject to 15.3% self-employment tax. That's separate from the ordinary income tax rate. So that's how self-employed individual are taxed the worst, because you got your income tax and then you got this additional FICA tax on top of that. So that's where you can get the 50, 60% of your income being taxed. You're also not eligible for 1031 exchanges when you consider a dealer, and you're not eligible to do installment sales. And you got to recognize that whole gain in the year that you sold it, even though you're collecting payments in future years. So that's a big piece of understanding of, okay, are you setting up your business to be a dealer, or are you setting your business to be an investor? And depending how you have it set up, then you can get into proper entity structures, um, timing of sales, so forth and so forth. Quite a bit here. I'm gonna take a pause. Questions, comments, concerns.
I have a question. How you doing?
Hey, how's it going?
Um, Now, on the investor side, what if you've held the property less than a year and you're owner financing? Is it going to be treated as a dealer type of transaction, or is there a way to kind of get that in that more favorable tax um, outcome and bracket, if you will?
And this is where I appreciate the questions. This is where the different items is like, hey, you have to check off every single one in order to be considered an investor. So if you just got one property that you only held for 6 months, but you really wasn't marketing as such, you're not selling a whole bunch of these, and facts and circumstances of with that property change, where there's a zoning requirements and all that, and you had to sell it. Now you could still qualify as an investor even though you held it for less than a year.
I have a question too. Is that like on a personal level, or can you mitigate that through different entities where you're like on in one entity maybe a dealer and the other one you're like an investor? Can you just like be both? I guess is the question.
Oh, you just jump right into my next slide.
Oh my God, man! Like I'm so sorry.
No,
Let's
man, no.
let's
I
go there.
like I take alley oops all day and I slam them in. So, so because what people think was like, hey, I have my LLC. I thought my LLC helps me save on taxes, and it's an unfortunate truth that LLCs by themselves, and I'll dig into your question a bit more, Robin, where like LLCs by themselves do not help you save on taxes. Their primary purpose is asset protection. Why social media and certain people are saying it helps you save on taxes, that's just for clicks and to get you to buy something that you may or may not need. So I try to be as direct and straightforward to people of what is the purpose of certain entity structures, and saving on taxes with your LLC is not it there. I'm not saying it's not useful, but you still want that limited liability protection. So I want to make sure that's not forgotten about. And if you have your entity or your asset in a state that you don't physically live in, you do have to file taxes for that state, even with that LLC. And then we get into, are you taking distributions versus guaranteed payments and how that determines whether that's taxable or not. So LLCs are suitable for all businesses, whether you're flipping or whether you're buying and hold. It doesn't really matter from that standpoint. As an investor or a dealer, you definitely consider the LLC as an item to have, because the primary consideration of it is it going to put your other assets at risk? And that means your personal as well as your other business assets. Now, when it comes to the dealer side of things, and to how to mitigate that self-employment tax, that's what we want to get into. Your LLC being taxed as an S corp. So the purpose of the S corp, it doesn't create any additional tax benefits. It doesn't create any additional liability protection for you. It's just it helps mitigate the self-employment tax. Why does it do that is because you now are an employee of your company. Like you have to be paying yourself a reasonable salary. You're filing separate tax returns, and depending on what state that you're in, there may be fees associated with being an S corp. But but you always want to make sure whatever someone's telling you something is the cost outweighed by the tax savings. So it may not make sense if you're just starting off. It may not make sense to be an S corp, because that's a separate tax return. Or you're gonna pay yourself a salary. You're looking at around $2,000-3,000 additional cost per compliance cost per year by being an S corp. Are you getting at least that in the tax savings if you're going to file that? When the time is right, I do recommend the S corp election for my flippers, land and building agents, brokers, property managers, contractors, so forth and so forth. That's when it makes the most sense. If you're just an investor and you're just passively holding on to land long term, or you're a limited partner in a syndication or a fund, or you have rental properties, your LLC by itself is fine, and getting the asset protection there. But since I am an accountant, let's go ahead and talk numbers. Like there will be math tonight, if I can keep y'all awake. So, so just just a single member LLC reporting on your Schedule C of your 1040. If we're like I said, we're not talking about federal and state income taxes, like just the FICA taxes, just the self-employment tax, like that's $14,000. So your minimal tax bill before you factor anything else will be your tax liability, I should say, will be $14,000 if you're netting $92,000, or whatever wherever you are at that point and applying that 15.3%. With that S corp election, and you're paying now, the 15.3% is no longer applied to your bottom line, it's applied to the salary that you're paying yourself. So half of that paid by the company, half of that paid by you through your W-2. So now instead of seeing that $14,000, you're only going to be taxed. Your payroll tax is going to be somewhere around $4,500, $5,000, creating about, was that 9,000, about $9,000 in tax savings. So that's how the S corp works when it makes sense. Now, if it's saving you $9,000 and it's costing you $3,000 to be an S corp, now you're in position to say that that makes sense. And now I can save on taxes, and now I want my land flipping business to flow through an entity that's being taxed as an S corp. Does that answer your question, Robin? Now, also, I also should say, like, because you're an S corp, that doesn't mean your LLC is a corporation now. It's just it's still an LLC. It's just you're just choosing for it to be taxed as a corporation, primary for this purpose here. There's really no other reason to. You don't want your rental properties or your passive investments in a in a corporation type structure or anything being taxed like a corporation. It'll create some estate tax planning issues for you if you want to pass down properties to heirs. It'll create some tax issues for them. So you want to be cautious. You have a separate structure of rental property or rent or investor related property assets, and then your actual operating activities in two separate LLCs. Now, just in case anybody asks, let's talk about C corps. Just in case somebody asks. Now, I'm gonna bring Batman back up because you definitely have to think through like if a C corp makes sense for you. Um, Now, yes, we have the 21% federal corporate tax rate. Um, it does help minimize the self-employment taxes because you're not required to pay yourself a salary, and you're it's not a pass-through entity like an S corp is. S corp, you get a K1 of your bottom line that's reporting your personal. The C corp, you don't have to worry about that. It pays its own taxes. There's some additional fringe benefits and some flexibility when it comes to ownership, and if you plan on going public. A lot of the Shark Tank guys, they set up their entities in C corps because they're not there's going to be little income being made with these startups, and then they try to hold them for at least, like I say, 10 years, and try to sell them at a huge gain at the end. But you do have to worry about the cons of being a C corp. Uh, you have the double taxation. Like if you take dividends from the entity, it's going to be taxed on your personal, and you don't get the deduction on the corporate tax return. So that's where the double taxation works. Get with a good attorney because there is some complexities when it comes to setting up C corps. If you have losses from your business, that doesn't pass through to your personal, so you don't get that benefit. There are state fees with being the C corp. And if you have properties in a C corp and you want to pass those down to your heirs, they don't get the benefit from the step up basis. What the step up basis is, if Robin bought a property for $100,000 today and it appreciates up in 50 years, appreciates up to half a million. If his child wanted to sell that property for half a million, if it's in the C corp, he's paying $400,000 in capital gains taxes. If it's not in a C corp, in a straight LLC, then the child inherits a $500,000 property, even though Robin bought it for $100,000. So that's how the step up basis works, is that the child inherits the property upon the parents passing or the guardians passing, at the fair market value of where the property is. So you want to make sure you take that into account when you're which property you have and what type of entity. So in my professional opinion, is not suited for not for it's best suited for like non-rental business. So if you're a flipper doing high volume, are you plan on going public, or you bringing in foreign partners, or you're reinvesting the funds and not taking distributions, that's when a C corp makes sense. If everything is going to stay and you just keep reinvesting back into the entity. Now, I would say we have to know what Trump is going to do, because if he lowers the corporate tax rate down to 15%, we got to make a serious decision now of if a C corp does make sense, because the average person's effective tax rate is somewhere between 18-22%. So going through all the complexities, and you may not see a tax benefit even at 20%, doesn't make sense. But if it was at 15%, I'm gonna have to take a second look at it now. So we'll see what happens with the tax changes that he's been proposing, and go forward from there. Any questions regarding the C corp status? I'm not that good. Keep it moving though.
Sorry, I have a question. Hi,
Oh,
I
okay.
love the details you're getting into. Most of it is going over my head, but I plan on listening to the recordings and to make it stick. But how easy is it to switch from C to S? Is it something you decide once and for all, or it's fairly fluid?
Yeah, so there's a form. It starts with an eight, and I don't want to. I don't want to mess with the number. But so there's a form to have your LLC taxed as an S corp, and then there's a separate form to have if you want your S corp to be elected to be treated as a C corp. Because when you first get your EIN number,
Uh-huh.
on the IRS site, you only have two options: is either corporation, which automatically is C corp, or it's LLC. You have to make a special election to have um, your LLC tax as or have any entity move to the S corp status.
Can it be reversed next year, for example?
Yeah, it could be reversed, but keep in mind that if you ever reverse it, because the IRS doesn't like people playing double dutch when it comes
Uh-huh.
to entity structure, so
Right.
they prohibit you moving an entity back um for 5 years if you decide to switch out of it.
Got it. Thank you.
Because I technically tell people it doesn't make sense for your LLC to be taxed as an S corp unless you're netting $50,000 a year.
Mm,
At that point, I am certain that the tax savings is at least breaking even, or more than the actual the fees associated with being an S corp.
got it. Thank you.
No, great question. And this is kind of a simple diagram. I tell people you're always going to have at least two LLCs. You're going to have one LLC for your passive investments, and that's where like your assets are making the money. So your landlord, if you're doing private lending, you're a passive investor. You may be holding on to land but you're not doing a lot of volume per se to be treated as a dealer. And that'll be reported on your Schedule E, no FICA taxes, so forth and so forth. If now once we get to the flip side of things, and you're in your active business, or you're running a CPA firm, that's when excuse my language, your ass is making the money at that point. So your flippers, your agents, contractors doing high volume type of activities there, that's reported on a separate schedule on your personal tax return, Schedule C. Or if you're doing the S corp election, it'll flow into Form 1120-S at that point. I have the revocable living trust at the bottom there because eventually we want to protect our names. Doesn't Revocable living trust is something also is just kind of a shell entity. It doesn't provide any tax savings. It's just, hey, you don't want anyone to kind of pierce your corporate veil and find out that your name is behind your LLC. It's up to you at that point. You're in your trust attorney determine how that's properly set up, and then that's all flows down and reported on your 1040 tax return. Questions on this colorful chart here?
Yeah, I got a quick question. I just wanted to kind of circle back to what Robin was asking, what I was thinking about. Just saying, like you know, I'm basically flipping deals, for cash, but I want to now start building up that passive income with, uh, you know, seller financing.
Mm-hmm.
And in looking at that, it would seem that you would need a double LLC structure, right? For
Yep.
those two, you would put
Yep.
it one in one side and the other deals on the other side, right? Am I
Yep.
right?
So if I was you, depending, like I said, I don't know your volume, what you got going on, Adam. So I would start off everything in one LLC just to kind of keep it simple. If you plan on selling it, then you move it to this LLC.
Well,
Or
the
so
other thing, well, the other thing was you get the corporate veil because it's a whole first in line, first in time. If
right.
the, so there's that aspect of it. What about personal interest foundations as an alternative to living trust?
Yeah, I mean that's another option as well. When it comes to, like I said, the aspect of how can I get them the most anonymity as possible when it comes to estate planning, trust, or the living interest, stuff like that as well.
All right. And finally, coming back to what Robin was talking about. So what we're looking at if I'm flipping and I'm spending money on marketing, right?
Hmm.
Or in this case, if I'm working with Robin, where now he's handling my disposition, at what point do I cross from investor to dealer or vice versa?
So it's
If that
based
makes
on
sense.
the full vibe. So it's not based on that one individual deal. It's based, okay, everything that you got going on. So if you're marketing and you're flipping 5+ a year, and you're not holding them for more than 12 months, they're going to be over here. The reason why I typically say start here and then move it over, because if this turns into an S corp, it's easier to move a property from a non S corp LLC to an S corp LLC. Um, is you create tax issues if you move it from an S corp to a non S corp entity. So if they're still separate non S corps now, then you can like, hey, well, I'm gonna flip this one, I'm gonna put it over here for now, or I know I'm gonna hold this one and put over here. Then you kind of keep them separate. But if you're going to start to kind of have that volume where you may have to start to kind of move stuff around, it's best to not have uh your flip LLC, or your it's best to have an LLC that's kind of a placeholder until you decide which one to do, and then move it over if need be.
Okay. Because in my case, some of those flips I did, well, they're six-figure flip,
Mm.
so it sounds like I probably would be an S corp candidate. Is
Yeah,
that
because like I
fair?
say, because not really based on the dollar amount, but well, in regard to the dealer investor status, like the dollar amount doesn't matter when it comes to the actual FICA taxes by themselves. Like that's when the dollar amount matters at that point. Where it's okay, cool. Like if you're at six figures net at that point, and you're doing multiple of those in multiple back-to-back years, like yeah, you need to get your S corp in order. And you do have until March 15th of this year to be an S corp for 2025. That's the deadline. Now they do allow a grace period until the end of the year to be an S corp, and you just say, "Hey, I just found out about this after the deadline." So you can file for a late election to be an S corp, but it just has to be done before the end of the year.
So I did a bigger deal probably about this time last year. So it's too late for that last year to get S corp.
In my experience, it's it's been a coin toss. It's been a 60-40. They don't accept if it's within the first quarter of the following year. Like I'll probably say I'm yeah, probably like a 60-40. They won't accept it. So like I said,
Okay.
it's worth asking, because either way, you either knowing what you have to pay anyway, or you get the benefit. So like you're not going to lose because you already know what your tax hit's going to be for not being an S corp. So it's worth asking or worth filing
Okay.
those. So you would so the it's a 2553 to have your LLC tax as an S corp, and you have to do a manual filing, and you have to submit that with your and provide explanation of why it's late. Like, hey, I just met this big headed bald bearded guy named Larry before for Valentine's Day, and he was telling me about S corp. I just learned about this and requesting a grace period to get my S corp in place. Now if they do accept, that means in 2025 your payroll has to be up and going at that point, and you can use QuickBooks or Gusto to help with like the 940 941 filings, so you're on time with that.
Okay. And anybody else, like, how do you do payroll with your Filipino VAs? Any
So
recommendations?
they are contractors, and since they don't have uh, uh, TINs, so there's no 1099 that's issued out to them. It's just a contract for um, almost like outside labor. It's kind
Okay, yeah, they
of
get their own taxes. They do their own with, so I could just list that as a
right.
contractor as a okay. Thank you. That
Yep.
answers my questions.
No problem. Thank you. Anybody else? Great questions.
Hey Larry, this is John. I have a question for you.
Yep.
You had mentioned 1099s, so not needed in the case of like an offshore VA. What about when you're funding deals or getting funding from like an investor or a lender? Um, are you required to distribute a 1099 for them in that scenario?
So we gotta make sure we're like words matter. So when you say
Yeah,
investor, are you talking about like a limited partner investor in a fund or in a partnership?
no,
Okay, so you're talking about more of a lender, a private lender per se, that
right.
you're so now and because uh depending if you because it's more if it's more than $10 in interest that you're paying, then you're required to issue out a 1099 INT to them for the interest that they were paid.
Yeah. Let me ask you one more question without getting too much into the weeds, but when you say interest, does that depend on how the deal, the profit split is structured? Like it could be like a debt deal where, a specific, percentage, um, is promised or interest is promised, or it could be, an equity profit split. Does that change 1099 requirements at all?
Yeah, so if you're talking about like the loan per se and there's interest indicated on the loan, then and you report it as interest on your end, it's a 1099 INT. If it's
Mhm.
not a partnership and you're sharing in the profits, um, I'm always cautious of the word equity because equity tends to turn into more of a partnership. So it's not you, it's me.
Yeah. Okay.
But if you're sharing in those profits, then it is a 1099 NEC that you're paying out to that you're issuing to that person. So whatever, if you all netted 100,000 and they're supposed to get 50, you're going to give them a $50,000 uh, uh, 1099 NEC non-employment compensation for that services there.
Got it. Okay, that makes sense. As a follow-up question, does it matter if if the investment was paid directly to your LLC and more or less, went through your business bank account versus being paid directly to the title company and have the funds received and then paid out through escrow?
That's a great question because that does matter. So 'cause if you received it and then you paid it out, you have to show that transaction of that's a 1099 from that perspective. If it's paid out in escrow, you're not required to because you didn't receive the payment. You just got your net amount per what's shown up on the HUD documents.
Got it. Got it. Okay. So if it was paid through escrow, then there is no 1099 requirement.
Right.
Okay. Okay. That answered my question. Appreciate it.
Well, thank you. Great stuff. Anyone else? All good.
I think that it's like really understanding the basics, right? Like, and when I hear you talking, like, whose head is smoking? Give me a head. Like, whose head is like, I don't understand all of that, right? Like, yeah, yeah, mine is too. I think like the biggest thing you need to do is like, especially when you're running deals, is that you have somebody helping you with that, right? Like, this is one of my earliest learnings because you burn more money by not doing so than um just like doing it, paying maybe one, two, three, $40,000 extra, but having it set up in the right way because you don't want to mess up with the IRS too, right? And probably once you're burned with them, that's always a problem, right?
Yeah, and there's a time and place to bring in someone where it's like, hey, if you're just starting off, all right, you just made someone need somebody to look over your shoulder. You may not need the full cost. Like, hey, can you just spot check this, make sure I didn't miss anything. As you grow, you want to be focusing on your business, not being your own accountant and tax person. And that can be one person, that can be two people, but um, delegation of certain things is key. Whereas like you're not going to do your own brain surgery, like you go to an expert for stuff like that.
I love that. Do you have any more slides?
Oh yeah, we keep going. Let's make sure I'm addressing everybody's questions.
Let's keep going. Let's go through the slides and we'll do Q&A in the back, right? Like we want to get the full juice here, right?
Um, and lastly, I want to cover real estate professional status. As you all currently are and continue to grow in your business, like okay, determining is a hot button term that's thrown across social media all the time. But it's important to know that the purpose of real estate professional status and claiming that is for the losses from your rental properties to offset your other income. Because just because you have a loss on a passive investment does not mean you can automatically offset. And there's what they call passive loss limitation. So you want to make sure that one, you can claim that status, and you have to be not just that, but material participation as well regarding your rental properties. So I have a lot of flippers who can claim those professional status, but they don't have rentals that could generate the passive losses to offset their flip income. Same thing with my land flippers, same thing with my agents, same thing with my contractors. If you don't have the actual like buy and hold investments that can generate the losses, like you claiming real estate professional status does not mean anything. It's just a fancy term. You combine that with cost segregation studies with your rental property. Now, with the 2017 tax changes from 2017 to 2022, we was at 100% bonus. We've gone through this sunset period the past few years, so we're at 40% bonus this year, and we'll dive a little more details on what that. As I mentioned before, you gotta have rental property if you really want to see the tax savings on your tax returns. The S corp is one thing regarding your active side of your business, but when it comes to your passive investments, this with rental properties becomes the you're really your one of your big sledgehammers to knock out a lot of your taxes. And once again, we'll have to see what Trump does because I know people are pushing for 100% to come back. So we've been keeping an eye on it. I'm projecting mid late summer before we really see anything because there's so much budget discussions that kind of filters into. So just waiting to hear back from our lobbyists up there in DC and see where it goes. How to qualify for realty professional status and material participation. I don't care that you got a real estate license. It doesn't matter. It is based on a time commitment. It does not based on your title. I have 60 something doors to my name. Like I am not a real estate professional because I spend more time talking about taxes than I do with real estate. Hoping to change that, but just know it's a time commitment. And here are the qualifications: 750 hours and more than half your work time. And that's with any real property trade or business, which makes it difficult for full-time employees. And there has yet to be a full-time employee that went to tax court and won real estate professional status. Part-time employees have, I think, three of them, but not all the full-time employees. They just shoot it down because IRS deems that if you're a full-time employee, you're working at least 2,000 hours a year. That means you're working at least 2,001 to claim reps. That's a lot of hours, especially if you got family and taking vacations and all that, and you need to sleep, I'm assuming, at some point. Material participation is rather similar to reps, but it's related to just to your particular property. Reps is just anything in particular. It doesn't have to be related to your properties, but material participation does have to be hours towards your own rental property. So either you're doing all the work, or it's 100 qualifying hours more than anyone else, or 500 qualifying hours without tracking anybody else's time. So if you check these two boxes of reps and material participation, then if you do have a rental property, then you can start to kind of look into like, hey, does the cost segregation make sense? And I'm a big guy, if you probably can't tell, so we're gonna talk about Big Macs and how that applies to a cost segregation study. Now it's been a while since I had a Big Mac, so I'm assuming that it probably doesn't cost $3.99 anymore. But that's your building itself. You bought that building for X amount of dollars. But just because you bought that and you got depreciated over 27 years, it's not all 27-year property. The cost segregation study is an engineering report that takes that building and breaks it out into different components. So who remembers the song? To all beef patties, extra sauce, slash cheese, pickles, onions on the sesame seed bun. Anybody remember the Big Mac song? No? Gene nodded her head. Thank you. I'm not by myself. So that's what the cost segregation study does. It breaks up your building into separate components, or you may have some 5-year property, that's your carpet, that's your appliances. You may have 15-year property, that's your fence, that's your pool, that's your porch and your deck. All those items that depreciate less than 20 years qualify for bonus depreciation. And why that's important, and we'll talk about these numbers. This is a quad that we sold last year. We had it since 2016, and it was time to let it go. Um, the state matters because not all states uh, allow for bonus depreciation, so you want to make sure if you do or do your state allows it or not, and we gotta know the land value. So they bought the property from us before for 600K. Roughly the land value per the city tax record is 25%. So that puts the building value at 450. So we were just taking the building value and their effective tax rate of 35%. Like that's roughly about $5,000 in tax savings that normal depreciation is going to give to that buyer um, of that property. Now, if they did a cost seg on that property, now we have to break out the 40% bonus part, which is roughly about 45,000. That part is then that 40% is fully deductible in year one, creating about $15,000 in tax savings. And I would say, like I talked this through with the buyer. Actually kind of convinced him to buy it at that price because of that. Um, but just that by itself creates $10,000 in tax savings. If one if he has other passive investments to offset the income against, or if he's able to claim real estate professional status and use those losses to offset his other income. So that's the power of the cost seg. if you're combining that with being a real estate professional, because that's when real estate professionals helps you save on taxes. Any questions on my numbers here? My mathing?
Yeah, I got a quick one. So, I mean, so you have the normal economic appreciation of a building, and this is a cost seg, and that applies for real estate professionals. So let's say maybe in a year or two, I start to acquire multifamily properties, right?
Mhm.
And let's say that I have a real Florida real estate license and I work for a developer in timeshare full time. Would that qualify you as a real estate professional situation? Even though
Now
technically I'm
the
not practicing in the traditional sense, it just requires a license. But to work in sales for a developer, let's say I work for Hilton because I like the
right,
benefits and the travel bennies and all the, you know.
yeah, because it's not your company, it like that will impact it from because it does see you as an employee, even though you may be real estate related in that company, but it's that company. So if you own 10% of that company, then you're allowed to use your hours related to that company for your real estate professional status. So that's where it's like even you can work like but some people try to Warren Buffett and his secretary they try to use her for some people try to use her for example like if she has a certain percentage of the company and she was actively involved with the sales like she can actually claim those professional status. So like it's stuff like that you have to be mindful of if you're able to use this. Now you still can use it. It's just do you have other passive investments that's bringing in income that you need the offsets against? So it does help from that perspective.
Well, if I own 10% of Hilton, I don't need it. But thanks.
Also, yeah, but also if your total income is less than $100,000, there is a $25,000 exemption that you can use up to $25,000 in losses to offset your non-passive income. And then for every dollar above 100, that 25,000 phases down $2. So when you get to 150, that's where you gotta be real estate professional status to be able to claim any of the losses from your rental properties.
Wow.
Hey
Guys,
Larry,
that was like, I mean, we have 8 more minutes left, right?
just
There
just
was a question in the chat, right? Like from Steve. He asked, so you can elect for any LLC to be an S corp, or that has to be elected when you set up the LLC. So if I just set up my LLC and I'm actively marketing and I plan on buying and selling more than 5 properties, should I go ahead and elect S corp? This is what his question was.
Um, I guess it all depends like what are you selling them for? Like what do you think that net income is going to be? So it's like you as I say, you don't have to rush into it. You can actually see how because if you're just flipping them, you're already going to be considered a deal if you would be doing five or more at that point. So it's okay, well, let's just see how the year goes and determine whether or not it's even worth it based off of your other expenses to get based off of net. It's not based off your gross. So okay, you may be doing trainings, you may be putting a lot of money in your first year of marketing. You may have a lot of year one expenses that's going to get your net income down pretty low. So you may not want to jump straight into it without knowing all the numbers for the year. But it's worth just something LLC, and then once you get some projections about second quarter, third quarter, all right, go ahead and file the election.
Steve, did that answer your question? Yeah. I'm just getting started, so wait and see. I think that was the conclusion of that, right? Like this
Yep.
is what I heard. So we had Javier and then Mario before we do the last action steps. Oh, you know what? We do the last action steps first,
Yep.
and
I
then we
mean,
do
because I
Javier
mean,
and then Mario.
yeah, I'm basically done now. Like I said, because I'm always real big on like, hey, like get with experts, like talk this through with people. YouTube University, social media is great, but you really want to make sure that it's narrowed to what your situation is. Get your books in order. None of this stuff matters if your financials are jacked up. So whether you're using accounting software yourself or you're using a bookkeeper, like get those numbers in order so we can start. You can start to kind of actually strategize and put a plan together of how you want to attack your taxes going forward. then you can execute that plan and then reassess at that point. Um, but like I said, that's really all the slides I had. Like I said, this is a team sport. Like I said, no one's doing this by themselves. I don't care how smart anybody is. Everybody has a team that they're using. And like I said, yeah, I definitely appreciate everyone that's hopped on and listened to me. Probably a little bit longer than I expected, but no, like I said, I think it was Mario had a question, and then Vlad.
Yeah.
Yep. Okay. The my question, Larry, was in the example you brought with the apartment unit, the value of the land was counted with 25%. And when I got you right, there are different percentage in different states. So how much is it in Tennessee? Do you
Well,
know
that
this?
was in Virginia, and it was closer to the water, so it tends to tick up a bit higher. Closer you get to in the coastal cities. So I seen property like land values as low as 4%. I seen land values as high as 60%, like truly off the water. So you have to be cautious of like it may be a good investment, and I don't want to deter you from those type of investments, but you may not have a huge tax play because the land value is so high per the city records or what the appraiser may say at that point. But it does vary. Like I said, state by state, city by city.
Okay.
That depends on what is nearby.
It depends really on the project itself or on the apartment complex itself, how much the
Yep.
land value will be counted at the end. Okay.
Yep.
Thank you so much.
Thank you.
It was
Vlad.
Javier, and then we do Vlad, right?
Oh,
All right, here we go. Hey, Larry, the depreciation from the cost seg study, can you carry that forward if it doesn't cover all, like if you have, available losses, I guess, or depreciation, can that be carried forwards, years into the future?
yeah.
Um,
So, great question. So, yeah, if you have passive losses from your passive investments or rental properties that you're unable to use, they're basically sub in purgatory on Form 8583 of your tax 8582. I'm sorry. And it carries forward for 20 years, and then as you have passive income come in, it slowly erodes that
right.
that 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 passive loss bucket.
Cool. Do you help people in Texas?
Yes,
Okay. All right. Thank you, sir.
thank you,
Vlad, it's your turn, man.
Hey, Larry, thank you so much for the information and your time.
thank you.
Uh, I just had a quick question, but obviously I see it on the screen. How do we get a hold of you?
Oh yeah, the I'm not sure what I'm pouring over my shoulder here. So yeah, so hit the QR code or check out my landing page. Learn more about me. Schedule an intro call or a consultation session. I think Robin may have my email as well because I'm trying to think this time of year my calendar gets full gets full rather quickly. So I will be willing to respond in email as well if you're unable to find a slot that works for you all.
I love that. Larry, it's the top of the hour. I think that was pretty enlightening, right? Like, there was a bunch of like really valuable shares. I think my main takeaway always is when I talk to CPAs is like, get one, get a good one, get somebody who understands your business. And this is why I invited Larry too, because he knows what we're doing. He's personally invested. We did a couple of deals together. He knows exactly our business model. He knows how we deal and flow, and we also. I think it's a great way for you to, especially when you don't have anybody, when you just have a bookkeeper, right? That's what we learned today. That's a bookkeeper or like a how did you say that? A tax. Uh, wait, I wrote it
I mean,
down.
the main thing is that like that interview whoever is coming to you, like get an understanding. Do they have to be investors? Like, no. Does it help? Yes. But just know, just get an understanding of like what do they really know about the industry that you're or the type of investments or businesses that you're getting into.
Yeah,
I tell you, like I train CPAs on what I do. Like the three letters behind my name, like does not account for what I had. I took the test 20 years ago. Like they taught none of this stuff. Like I had to self-educate myself on and how investments and taxes merge together. And there are a lot of great CPAs out there that do the same, and there's a lot of CPAs that don't. So it's like just be cautious of who is just kind of throwing out information out there, but can't really speak to what you have going on.
absolutely.
Was that a
Guys,
VOI question?
yeah, guys, reach out to Larry. He's a great person to talk to. I always enjoy when I have him on the phone, and he's here to help. I say thank you so much, Larry, for coming over, for sharing some wisdom and some value. We see each other next week, and I say thank you for spending that hour with us, and bye bye, everybody.
Thank you.